Good morning. These are the things that matter most in Europe's market today. AI memory is surging in Asia. Japan's exports are still powered by chip shipments. Oil risk is back on the geopolitical screen, and Treasury buybacks are trying to calm a bond market that still has a debt problem underneath. The central question is simple. Can Europe keep rewarding semiconductor and industrial technology if oil, yields, and geopolitics force investors to demand cash flow proof instead of broad theme exposure? Start with the chip signal. CNBC reported that SK Hynix shares surged more than 12% in Seoul after the company announced a massive stock buyback. CNBC also reported that Japan's exports beat estimates in July, powered by robust chip shipments. That matters for Europe because AI is not just an American software story. It is a memory, equipment, power, and industrial supply chain story. For Europe, the cleaner side is ASML, ASM International, and B Semiconductor, where chip capex and advanced packaging can turn AI demand into real orders. Infineon and STMicroelectronics also matter, but they need proof that automotive and industrial demand are not dragging against the AI signal. For private investors, the filter is proof quality. A memory stock buyback does not make every European chip name equally attractive. The useful question is whether backlog, pricing, and order momentum confirm that AI spending is still reaching Europe's suppliers. Second, geopolitics has moved back into the oil and margin map. CNBC reported that President Trump announced economic warfare on Iran and threatened serious consequences for its backers. If that raises perceived energy or shipping risk, Europe has to split the market between cash flow support and margin pressure. The cleaner side is Shell, Total Energies, and BP if crude and energy security risk support current cash flow. Pressure sits with Lufthansa, IAG, and Ryanair if fuel costs or travel sensitivity move before ticket pricing catches up. For private investors, the important mechanism is not the headline threat. It is who gets paid by higher energy risk and who has to absorb it through margins. Third, bonds are calmer, but not solved. CNBC reported that Treasury buybacks are being used to steady the bond market, while U.S. government debt has passed $40 trillion. CNBC's Daily Open framed the issue as Treasury attempts to rein in yields while debt keeps swelling. Europe cannot ignore that because higher global yields change valuation math for banks, real estate, utilities, and growth stocks. The cleaner side is quality banks such as BNP Paribas, Santander, and UniCredit if yield curves support net interest income without breaking credit. Pressure sits with leveraged real estate, long-duration growth, and businesses that need cheap financing to justify valuations. For private investors, the filter is whether lower day-to-day volatility in bonds becomes real financing relief. A calmer yield screen is not the same as a lower cost of capital. Fourth, bank technology is becoming part of the competitive map. Investing.com reported that Citi, HSBC, and Standard Chartered adopted Ant International's Forex AI tool. That may sound like a back-office story, but the hidden mechanism is market share defense. Large banks are using AI to compress spreads, speed up cross-border payments, and protect institutional client flows. For Europe, the cleaner side is HSBC, Standard Chartered, and large transaction banking platforms if AI tools improve service quality and operating leverage. Pressure sits with slower banks and payment intermediaries that have weak data, weak scale, or little pricing power. For private investors, the takeaway is to separate real workflow adoption from AI slogans. The question is whether technology lowers cost to serve or improves client retention, not whether a bank can say AI in a press release. Here is the stock-led watch list. First, ASML, ASM International, and B Semiconductor. Does Asia's memory signal reach European equipment and packaging suppliers? Second, Shell, Total Energies, and BP. Does geopolitical energy risk support cash flow without destroying demand? Third, Lufthansa, IAG, and Ryanair. Do fuel costs become the first visible margin pressure? Fourth, BNP Paribas, Santander, and UniCredit. Do calmer bonds help banks without raising credit concern? Fifth, HSBC and Standard Chartered. Does AI and Forex become a real transaction banking advantage? Market bias. Europe can open selectively constructive if chip-proof and bank technology support quality names, but the tape is fragile if oil and yields start taxing margins at the same time. The mistake to avoid is treating every AI, oil, or bond headline as one trade. Today's market is about transmission, which companies convert the headline into orders, cash flow, or margin pressure. That is the Europe Morning Market Brief for Thursday, 20th August. Watch the proof, not the label. Research context only. This briefing is not investment advice, not a trading recommendation, and not personal financial guidance. No price targets, stop losses, position sizing, or portfolio instructions are provided.